looking to purchase a house and you're eligible for a VA loan. You've heard great things about the program, but you don't know where to start. So today, I'm going to show you my 11 favorite tools surrounding the VA loan, which I believe are going to benefit you in the short term as well as the long term. My name is Aaron Benton. I'm a local mortgage lender and host of this channel. I get calls, texts, and emails every day from people just like you looking for home financing advice. So whether you're looking to purchase in a month, a week, or even a year, click below, schedule a call, or set up a video meeting so that I can understand your financial needs and schedule and tailor a plan exclusively for you. But stick around, because today I'm going to talk about the VA loans, and in fairness, I believe number 8 and number 11, those are my two favorite inside of those 11, if you will. So hang out, sit back, relax, learn a little bit about a VA loan with me, and tap that bell again for notifications, subscribe so that you'll be the first to know when I release any new videos. Benefit number 1, 100% financing. VA allows you to make 0 down payment. USDA is another program. It does allow for 100% financing. However, there's geographic restrictions. It's going to be meant in rural areas. So you're not going to find 100% financing with a USDA loan in a city or suburban. Now, FHA or other state housing initiatives, they do have down payment assistance, but they come with income caps and sometimes home price limits, so much more challenging. Not only that, the VA, when you get 100% financing, the interest rate is very aggressive anyway. So 100% financing, VA loan, it's one of its kind, arguably one of the best topics you can have or best features. Benefit number 2, no mortgage insurance. Other programs, you put less than 20% down, conventional loan, FHA loan, USDA loan, you're putting down less than 20%, you got mortgage insurance, an added fee that doesn't have any benefit to you as the consumer. But VA loan, whether you're putting down none, 20%, 50%, no mortgage insurance. FHA is going to have mortgage insurance throughout the life of the loan. Conventional financing, less than 20%, you're going to have mortgage insurance. 20% or more, no mortgage insurance. But let's be real, 20% is quite a sum of money when with you have the VA loan, 100% financing, no mortgage insurance. Very powerful, saves you on your monthly payment. Benefit number 3, now the VA loan does charge a funding fee. However, that can be rolled into the loan. So when we talked earlier about, hey, 100% financing, yes, you have this funding fee, and that funding fee is going to change based on if it's your first use, you've used the VA loan in the past. Sometimes you're exempt from the VA loan. And to be exempt, you could have been an active military and have received a Purple Heart. You could be a surviving spouse. You could have had a disability that took place while on active duty. Those are ways you could be exempt from the funding fee. But if you do pay the funding fee, which is a graduated scale, so if you put down less than 5% and it's your first time using it, it's 2.15% of the loan amount, it gets rolled into the loan. Now again, there's a scale and you can see the chart on the screen, but this is very powerful because you do not have to bring, not only do you not bring the down payment, but that upfront fee gets financed into the loan. So essentially, you're financing greater than 100% of the house should you get 100% financing. But nevertheless, when you're trying to save upfront cash, being able to finance the funding fee, very helpful. Benefit number 4 is competitive rates. Now the VA loan, if you have an 800 credit score and you're applying for a conventional loan, you have an 800 credit score, you're going to see relatively similar rates, if you will. I think the VA loan is going to be slightly lower because they're always a little bit lower, but where you start to see the real benefit to a VA loan is if you don't have ideal credit. So if you had a 680 credit score and we're looking at a VA loan and you're also looking at a conventional loan, let me tell you, that VA loan is going to be a solid 0.5%, potentially more, less, if you will, than a conventional loan. So you start to see the VA interest rates really take off, if you will, because they're a little bit more forgiving if the credit score is not, if you will, in the upper 700s or such. You're going to notice that VA loan is more forgiving, which is very beneficial, again, as we all work towards the lowest monthly payment possible. Number 5, kind of piggybacking on the last one, VA insures their loans. And what that means is that they're willing, each lender has their own different kind of criterion, if you will. They're going to have what's called credit overlays, but VA will allow you to lend all the way down to 500. And so the company that I currently work for, we do have a product that goes down as low as 500 as the credit score, and that would be with 100% financing. So a very, very powerful tool because again, if credit is not ideal, we're talking in the 500s here, a VA loan is still eligible. Number 6, the VA is more forgiving when it comes to credit events in terms of the waiting periods. They're shorter with the VA than they are their counterparts. For instance, on a VA loan, if you were to have a foreclosure or a short sale or a Chapter 7 bankruptcy, you'd have to wait 2 years from the discharge date to get a new loan. Conventional financing, if you were to have a foreclosure, you'd have to wait 7 years. With a Chapter 7 bankruptcy, you'd have to wait 4 years. Chapter 13 bankruptcies on a conventional loan, you gotta wait 2 years after the discharge or 4 years after the dismissal date. Whereas with a VA loan, yet again, more forgiving. If you make 12 on-time payments, you can jump right back in and apply for a mortgage after that Chapter 13 is removed for 12 months, or you've been removed from 12 months from that bankruptcy and you've made 12 on-time payments on that Chapter 13 bankruptcy. So the VA more forgiving in terms of if you kind of have a little slip up or a credit event, they are willing to get you back in the game, if you will, a little bit quicker than say a conventional loan. Number 7, VA is a little bit more forgiving or common sense, if you will, when it comes to looking at income. So what I mean by that is conventional financing, FHA, USDA, jumbo financing, all other kinds of financing, with the exception of VA, they look at debt to income. So they look at your monthly debts versus your monthly incomes. And for conventional financing, for example, if your monthly debts, your car payments, your house payments, you say student loans, boat loans, anything like that, credit card payments, monthly minimums, if those all added up are greater than 50% of your monthly income, then you don't qualify. They look at it as residual income. So yes, there's still a debt to income feature, if you will, because you still calculate the debts, you still calculate your income, but what they look at is how much money is left over. And so for someone who maybe has a larger loan amount specifically, they're going to be able to qualify with a debt to income that goes over 56%, because they're going to show that they have money left over after they pay their bills, after they pay for, say, childcare, after they have their utilities, and of course their normal debts that you'd see on a credit report, like student loans, car payments, mortgages, things of that nature. After all those are taken away, if they still have money left over, that is considered residual income, and that can be a strong qualifier. So the VA a little bit more forgiving, simply because, in my opinion, they look at the monthly qualifying ratios, if you will, a little bit more common sense wise, utilizing residual income. Number 8, arguably one of my favorite ones. I mentioned that in the very beginning. I love number 8. I love seller concessions, or really the ability for the seller to provide some closing costs and upfront cost assistance. And so understand, with a conventional loan or other kind of loans, FHA loan, the closing costs are mortgage-related costs, attorney-related costs. You could have escrows, first year of insurance, neighborhood transfer fees, points, if you will, or interest rates, buy down. Those are all considered like standard closing costs, if you will. And those loans, conventional FHA loan, you can pay for those with seller concessions, just like with VA. But what VA has, yes, the seller can pay for those standard fees that I just listed for conventional and FHA, but they go one step further. You can actually get 4% above and beyond those normal fees. So for instance, the seller could pay the buyer's VA funding fee. They could also help pay off debts. Wow, the seller could actually pay off debts that would allow the buyer to qualify for more and potentially buy the house. Very, very powerful. They can also, again, pay down the points. They could prepay taxes and insurance. But the reason number 8 is so happy for me, or so strong in my opinion, is because could you imagine the seller can actually pay down or pay off an auto loan or a student loan or something that you have that maybe is hindering your ability to qualify? And again, that is 4% of the purchase price or the appraised value, whatever is lower. The VA calls it reasonable value. And you get to take that 4% in addition and use it however you see fit. So it's 4% plus standard closing costs that you would see on other loans. So very, very powerful tool there is your ability to be able to access seller paid closing costs above and beyond what all the other loan programs offer or allow you to do. Number 9, the VA benefit. You are a veteran, you served, you're active military, you earn that entitlement to VA for life. And so this is a lifetime benefit. This is not just a coupon that you get to use once, you cash it in and it's done. Like I showed you before in the funding fee, you got your first time use, you have your subsequent use. You do have to pay attention to entitlement because VA, they do lend you 100%, but when you start accumulating multiple VA loans at one time, that is when you're gonna notice that you can only borrow so much. You can't get 100% financing for every single property that you own if you have multiple VA loans going on all at once, meaning say you own 2 houses already and they're financed and now you want to buy a 3rd house. There is this VA entitlement, which I will dive into in a later video, but nevertheless, you can still get a VA loan. It just might not be 100% financing. You still get the same benefits, no mortgage insurance, things of that nature, but you just got to pay attention to how much you can actually borrow because there is an entitlement calculation once you start to own multiple properties utilizing VA financing. Number 10, the VA loan is an assumable loan, which means if you have a monthly payment, or rather you have an interest rate and you have a balance, somebody else, VA or non-VA, can assume that loan. Now it does need to get approved by your loan servicer, but that is a huge selling point, if you will. I mean, understand individuals that had interest rates from the 2s and the 3s during COVID, years 2020, 2021, 2022 a little bit, those rates are very sought after. So if you were to go into the market today, maybe you're gonna see 5-6% in that vicinity. So you can certainly save some money, or the buyer can save some money if they were to assume your loan. Now there is one catch to the assumable loan. Understand that if you had a loan for say $230,000, but you're trying to sell your house for $350,000, you can only assume, or the buyer can only assume that the amount that's left on your loan. So if you owe $230,000, the buyer can only assume $230,000 and the interest rate associated with that $230,000. But now understand, if the house was listed at $350,000, you still have $120,000 gap there, or difference. And so the buyer would need to either bring cash or they'd have to get secondary financing. And again, those interest rate would be market rates. But for the bulk of that loan, if they want to assume, they can certainly assume what you have for your first mortgage and the interest rate associated with that. In addition, they wouldn't have a 30-year loan anymore if they inherited, or I should say that they assumed your loan at year 27 or 27 years to go. They'd have 27 years worth of payments left. So it wouldn't reset back to 30. Another piece here yet comes back to entitlement. If you are letting someone who is not a military member assume your loan, understand that your entitlement would not get restored until that home was sold, and then that entitlement or that loan was paid off, and then you would see that your entitlement is restored. So keep that in mind when you want to let somebody assume your loan. Now again, if it's a VA to VA, your entitlement can be restored, and that person, the VA member or VA eligible borrower who is assuming your loan, their entitlement can take over yours, if you will. But if you're letting somebody like myself, who's not VA eligible, assume your loan, understand that your entitlement will be tied to that house and to that loan as long as I possess the loan, because I assumed it, but I didn't have any VA entitlement, if you will, to restore yours. But nevertheless, assumability, very, very powerful, especially if you're in a competitive market and you want to use that as a selling factor to be able to give the little nudge above your neighbor who doesn't have a VA loan. All right, the last one, number 11, arguably my favorite, the VA IRRRL, an interest rate reduction loan. And so the VA makes it very easy for someone to refinance. As a consumer, it's arguably it is the easiest loan in my opinion, because you do not need to income qualify, you just credit qualify. So sometimes you need a credit pull, hard, soft, maybe you don't even need a credit pull. But what are the parameters that allow you to refinance for an IRRRL? A, you have to have made 6 on-time payments, be current on your mortgage. The loan had to have been in existence for at least 210 days, and the interest rate had to have gone down at least 0.5%. if you are going from a fixed rate to a fixed rate, if you are going from an ARM to a fixed, an adjustable rate mortgage to a fixed, that 0.5% doesn't count. So you could just switch from a ARM to a fixed and keep the rate the same, because that is considered a net tangible benefit, or a benefit to the borrower when switching from an adjustable rate to a fixed. But nevertheless, you do have to pay a VA funding fee. It is 0.5% of the loan amount. It gets financed into the loan. And like always, if you're exempt from the VA funding fee, you do not need to pay a funding fee when doing the interest rate reduction loan. So the beauty of getting a VA loan is, if rates come down, the ability to refinance is there and pretty easy. So VA interest rate reduction loan, number 11 on the list, arguably my favorite one. Again, that as well as the seller concessions, number 8. So thanks for sticking around. You made it to the end, and I hope you really enjoyed the video. I know 11 different topics for the VA that I thought was beneficial. I hope you thought it was beneficial too, because it really does help your buying power when you recognize you can get 100% financing. Your interest rate can be lower than your peers who are not eligible for VA loans. The seller can come in and help you with closing costs. They can pay off some debts to get you to qualify. You can utilize the VA IRRRL, the interest rate reduction loan, regular or pretty independently or regularly if the situation presents itself. So these are all really, really positive tools. Now again, you earned it. We thank you for your service, but utilizing the VA loan is certainly something that when possible, you should use it, because it is nothing but lower monthly payments and helpful to you. So thanks for sticking around. Thanks for enjoying the video. If you like the video, please click the like button below. Share my page with your friends. And I hope one day to get to meet you. But if not, I hope to at least see you on the next video. Thanks for checking in, and hope to see you again.